Everybody, welcome. In today's video, we're going to answer the question, why would somebody put money into a whole life policy? I'm sure if you're here, you've probably heard either one of two things or both, that whole life is a horrible place to put money and whole life is a really good place to put money if it's structured properly. So we're going to talk about why it might be a bad place to put money, depending on what you're looking for. We're also going to talk about why it might be a good place to put money. So let's just rock and roll. So if you're not familiar with what whole life insurance is, there's really two different ways to design it. But first, let's talk about what it actually is. So it's exactly what it sounds like. It's life insurance coverage designed to protect you for your entire life, or if you live to be 121 years old. So you pay. Some whole life insurance will allow you to pay, say, like one payment. Some will allow you to do 20 pay, 10 pay, 100 pay, or unless you live to a year 100. There's all kinds of different ways to do it in the more traditional sense. But why would somebody get a traditional whole life insurance policy to start with? Well, they don't want to run the risk of, getting something like a term insurance, because term insurance is only good for a specified period of time. And then when you get out of that window, then you're just kind of, you're on your own, and hopefully you've been investing enough and the market has gone well enough to where you can cover your retirement income, you can cover your health expenses, and you have something to pass along to your beneficiaries when you do pass away. Now, somebody would get whole life insurance because they don't want to run the risk of getting outside of their window for term coverage, and then they need more insurance because they don't have enough money or because they just want the additional protection, and they can't get insured because insurance companies, I don't know if you know this, insurance companies are in the risk mitigation business, and they're going to have to pay out a claim for somebody who's old because that person is more likely to die. Just is what it is. So that insurance is going to be more expensive. So somebody gets whole life insurance earlier on, so then that way they're covered no matter if they have a health condition come up or if their term coverage expires. That whole life insurance covers them. Now, there is a trade-off for that. It is going to be more expensive. And this is part of the reason that your Dave Ramsey's, Susie Orman's, White Coat Investors, why they hate whole life, because it is more expensive, but you're also getting locked-in protection for your entire life. Whole life, like a traditional policy, is really good for estate planning that wants to pass along a large sum of money to their beneficiaries tax-free. There's nothing wrong with the traditional policy. It's just that if you're getting into a traditional policy is not what you want to get if you're looking to, accumulate cash value, which we'll talk about here in a minute. But let's look at this traditional policy here first. So let's say this person pays $5,000 a year in premiums. I think that's like $420 a month, something like that. That will get them a death benefit. We're going to do some simple math here and call it $500K. So when this person dies, their beneficiaries will receive $500,000 tax-free. Now, let's look at year one. Death benefit is going to be $500,000, and you'll see why I'm keeping track of the death benefit here once we get over to this cash value side. But the amount of cash value that they have access to after year one is a big whopping $0. Now, this is how your traditional is going to be set up this way. It's not designed to accumulate cash value. So we'll talk about that here in a minute, though. Premiums, just to keep score. We've paid $5,000. Now, let's jump ahead to year 5. So for our traditional policy, year 5, we have access to $11,000 of cash value. Death benefit is $500 still. The premium, I'm just going to do this all the way down because it's not going to change. If you're keeping score, premiums by now is $25,000. So we paid in $25,000 to have access to cash value. And let me back up for a minute. Cash value, what it is, it's basically the insurance company allowing you to have access to a portion of your death benefit before you pass away. Because typically with life insurance, you can't access your life insurance money unless you kick the can. So that's what the cash value exists for, is for you to, some people use it as an emergency fund. Some people pay for, their kids' college with it. You can use it for any number of things. But that's what the cash value is. It's basically the equity, for lack of a better term. It's the equity you've built up into the policy thus far. So that's what cash value is if you're not familiar. Now, let's jump ahead to year 10. Year 10, we have access to, we'll call it $36,000. And we've paid $50,000. in premiums so far. Now, for my rate of return folks, it's not a good rate of return. This is why people don't like traditional policies for cash value. Now, let's jump ahead to year 20. We have access to, we'll say, $98,000. We've paid $100K in premiums. So if you're looking for a policy designed to accumulate cash value, like the traditional ain't it. Sorry, it's just not. Now, why is the traditional the one that's more often sold, and why does that result in a lot of vitriol, using fancy words? Why does that result in a lot of vitriol from people like financial people online? Well, it's because people online talk about infinite banking and how you can use it to, get generational wealth. But then when it comes down to brass tacks and the agents are filling out an application for somebody, it's the traditional policy that somebody is getting, which is terrible cash value accumulation. But why does the agent do it that way? Because the traditional gets the agent more commissions. That's why. So unfortunately, the insurance companies, just to peel back the curtain here, the insurance companies don't incentivize agents to properly write policies specifically to accumulate cash value, because the agent's commission is based on the death benefit, how much death benefit there is in the policy that's being written. Now, let's take a look at a policy designed to accumulate cash value. So let's do the same amount of premiums, so $5,000 a year. But I want you to notice something here with this death benefit. Initially, it's going to be $99,000. What the heck? In this particular case, by the way, I'm doing this for a 35-year-old male. $5,000 a year premium. Well, why the heck is there such a big death benefit discrepancy between the two? Well, if you're not familiar with the machinations, another fancy word, if you're not familiar with the machinations of how a whole life policy designed to accumulate cash value works, part of this premium is being split up into two different things. So you have a portion of it going to the death benefit, aka the base, and then you have another portion of it going to paid up additions, or PUAs. The paid up additions are what's going to cause the cash value to accumulate more and more and more. And with the cash value side, you can also, the policy on the left does not pay dividends, even though it's from the same company. The policy on the right is going to pay dividends, and you can use those dividends to buy more paid up additions. What the hell is a paid up addition? A paid up addition is you buying smaller blocks of insurance that will increase your death benefit and thereby also increase your cash value. For this particular example, we have 40% of this premium going to the base. The other 60 is going towards paid up additions. You remember when I said earlier that the traditional policy is more commission for the agent? Well, in the cash value, their commission's reduced by 40% in this particular example. So if we're doing some math, 5,000 times 0.4, that agent gets a $2,000 commission for this, whereas in the other one, it's going to be $5,000. It's more than double. So this is why agents will get you into a cash value policy, but write you one that's traditional. It's just more commission. Unfortunately, that's just what happens. So this is why it's so important to find an agent that knows what the heck they're doing and knows how to fill one of these out. It's also important for you to know how these work, so that way you know what the heck is going on and you'll know what to do. Now, with a cash value policy, depending on how it's written, and these percentages are, they can change. So you could write one that's 10% base, 90% paid up additions. So you're going to have more cash value accumulation, but you're going to sacrifice some growth of the cash value later on. And there's a whole other video that I have showing that. But for the sake of this example, let's take a look at some numbers. Death benefit, $99K. Cash value, call it $2,800. So you can see immediately, and we've paid in $5K. So you can see immediately, we have access to all this cash value right here. And over here, we have access to none for 3 years. You can't see that, but in the illustration I'm looking at it on the left, you don't have access to any cash value for the first 3 years. Whereas on the right, you have access to cash value immediately, year 1. Let's fast forward to year 5. What's our death benefit here? $125,000. Cash value, $17,000. Premium, we've paid $25,000 so far. So you can see this is looking a little more favorable, a lot more favorable than the previous example. Let's fast forward to year 10. Death benefit, $154,000. Cash value, call it $36,000. Premiums, we've paid in $50,000. And keep in mind, like I know these numbers, year 10 for the traditional and year 10 for the cash value look fairly similar, but keep in mind on the right here, I'm not including dividends from the insurance company. I haven't included that yet. I'll show you the difference it makes here in a second. Let's look at year 20. We'll call it $206,000, $206K, and then we have $80,000. And then we've paid $100,000 in premiums. Well, what the heck? I thought the cash value accumulation should look better than the traditional. Hold on. Let me include those dividends for you. So with these dividends, this particular company's dividend rate right now is, I think like 5.1, 5.2%, something like that. Year 1, death benefit still $99K, but our cash value with the dividend is $3,300. We paid in $5K in premiums. Year 5, our death benefit's $133,000, and our cash value is $21,000. It's looking a lot better than the previous example of the cash value. We paid in $25K. Year 10, our death benefit is $182,000, and the cash value is $50,000. And we've paid in $50,000 in premiums. So remember what I said earlier, this is how this particular policy is designed. It's going to take a while for these to break even, and that's with the dividends. Unfortunately, it's just how it is. If you were to do a 90-10, as in over here, it's going to break even a lot quicker. But here in year 10, we finally broke even. Now let's look at year 20. So in year 20, our death benefit is $293,000. Cash value is $132,000. And we've paid in $100,000 in premiums. So at this point right here, you could elect to stop paying premiums. I wouldn't recommend it. The whole point of this is for you to pay as much premium as you can for as long as you can. The more premium, it's like running a business. So my business owners and entrepreneurs here know what I'm talking about. The more money you can invest into your business for a longer period of time, the more you're going to get out of it later on. Same exact thing with this. A lot of corporations, any new subsidiary they open, they don't expect it to break even for 7, 8, 9, 10 years. So for every one of these policies that you open, you got to look at it the same way. We have to unmarry or uncouple the fact that a lot of people think that paying premiums is evil. Life insurance is a scam. It's not if you set up these policies in the correct way. You got to find an agent that knows what they're doing. We have to look at each one of these policies as a business, and we got to put as much money into it as we can for as long as we can, and we'll reap the benefits later on. So you could probably do some extrapolating with, say if you were to pay more for a younger person, like these numbers are only going to look better. And for this particular company, as far as the cost of insurance goes, this was the most expensive option. I didn't pick the least expensive as far as cash value accumulation goes. These numbers would be even more favorable if we pick a different product that's a little less expensive, and it looks even better if you've got good health. You'll just accumulate cash a lot quicker. Of course, it's insurance, so hopefully you know that. The reason that somebody would do something like this, put money into a vehicle like this, is because maybe you're somebody that wants more control over your money. Maybe you're somebody that doesn't want to put up you're not the one that wants to bear all of the financial risk by putting, such as what happens when you put your money in the stock market. Like if it goes down 40%, you're the one who's shouldering the 40%. It ain't the market. It ain't your broker. It's you. If you're somebody that looks at IRR and like rate of return, like the IRR of a policy, like a whole life insurance policy for cash value is going to be like 6% at best. But the other thing we have to uncouple from our minds is that people aren't doing infinite banking or putting money into a whole life policy for the rate of return. The rate of return is just one small, minute part of what makes this system work for people. What people care most about is control over their capital. They have an available pool of capital that they can use at any time without having to, fulfill somebody's arbitrary obligations for being able to have access to money. So for example, if you want a car, what do you have to do? You got to meet the lender's requirements for somebody that's suitable to give a loan to. And I get why they do it, but you got to open up your whole financial life to them. So people are tired of that. Some people, want to pay for their kids' college without having to go through, the FAFSA process and, fill out or having to deal with all of the interest rates and like all those kinds of things. Some people don't want to deal with that. The beauty of having a whole life insurance policy for cash value is, like I mentioned a second ago, you have an entire pool of capital that you can use however you want. You call up the insurance company and say, hey, I want access to my $30,000. They'll say, okay, where do we send the check? That's it. No further questions. Oh, and by the way, the cash value growth within these policies, tax-free. And if you're a doctor or if you're a nurse, somebody that has to get malpractice insurance, ask your state. It's going to vary state by state. But generally speaking, these whole life insurance policies are exempt from, any judgments. Now, what I'm personally a big fan of using the cash value for is leveraging it into something that's going to provide me cash value to where when I do borrow against my policy, because it is a loan, it's not like a normal loan that you're used to. And I'll do a video about that. But something that's going to provide me cash flow to where it pays off the loan. Maybe it pays for some of the premiums, but then I have the equity in that asset later on. That's just one thing. Some people like to use it to fund their lifestyle, which is fine. There's all kinds of different things that you can use this for. And it's free from taxes. You have control. It's a vehicle to where you actually have control over your money. So I hope you found this helpful. Check out some of my other videos if you're curious on how this infinite banking, whole life stuff works or insurance in general. And reach out to me if I could potentially help you. Thanks.